Hello, it's Brian Akers, and welcome to the Akers Financial Group Classroom Session. Winning in Retirement is a radio show, so sometimes we call this the Winning in Retirement Classroom Session on income taxes. Yes, it's tax time. A lot of things have been changing. Recently, they changed tax time from April 15th to May 17th for federal, and just before that, they changed Maryland to July 15th. This is when your taxes due, and you can file extensions into October, which has not been changed. Also gives the extended deadline for contributions. So as we welcome you to the show, I want to remind you that Akers Financial Group is there for you. Just give us a call anytime with any question and talk to one of our team of advisors or one of our other team members with any questions you might have. Our show and our classroom today is going to be with myself, Jeff Akers, and then Alex Monk talking about taxes, ideas that can help you with this tax season and the 2021 tax year as you do some planning in these unusual times. For listening today, we have some special gifts. I want to cover those first. All right, let me share with you a screen, and that screen is going to cover our amazing gift, Akers Financial Group blanket. This is a one-of-a-kind, first time in the history of Akers Financial Group in over 15 years. This gift is for first-time watchers. Everybody that comes to our talks actually can get other types of handouts. One of those handouts is for the ability to, to understand tax a little bit better. It's probably the best way to put it. We have this pocket table. It's a booklet that has about 8 different pages of guides, a lot of information there. Jeff Akers in his segment will be going over this pocket table. So the Kaplan pocket table will be sent out to everyone that watches the video. As you sign up, we'll send it to you as soon as possible. Also, we have some information for you. We covered just a minute ago. It's about the tax deadlines. Federal tax deadline for taxes being paid is by May 17th. You need to electronically file. Don't paper file this year. I don't know when it'll actually get looked at. Maryland state tax deadline is July 15th. These are all important dates for when you owe money to these federal and the state of Maryland. All right. Hopefully you've all heard about Daniel Allen Tax Service. This company is owned by my son, Daniel Allen, and myself, Brian Allen. Actually, my son's not named Daniel Allen. My son's name is Noah Akers. I'm sorry, it's so funny. So Daniel is Noah's middle name, and Allen's Brian's middle name, and we took those together to create a company called Daniel Allen Tax Service. This is our website, Daniel Allen Tax. As you can see by the website, there's a lot of good information there. What you need to do is to find out more about Daniel Allen Tax, so go onto the website, danielallentax.com. Our team of people that we have at Daniel Allen Tax, Noah is a managing partner of Daniel Allen Tax and helps organize the company. And our accountants are Danny Akers, who we're buying the tax business from. He is going to a more of a part-time basis this year as we buy his Akers Tax Service and create the new one, Daniel Allen Tax. We have Josh Lindner switching over to Daniel Allen Tax to do a lot of returns this year. He's an enrolled agent. And also we have Alex Monk assisting with tax preparation under this company. And joining us in the tax service is Caitlin Lookingbill. She has been a tax major, tax classes and income accounting and all kinds of major when she's at House University, graduated a few years ago. She also works in our operations department, but she's helping us with our tax company throughout the tax season. So this team of people is there to help you. And of course, the one photo missing is my mother, Margaret Akers. She's had a great career of assisting my father and helping with tax preparation. So this is all information that you need to know when it comes to understanding what's going on with taxes. If you need somebody to help you with your taxes, you can contact us at Daniel Allen Tax. If you have your own accountant, that's perfectly okay. We look forward to helping you with any information you might need with them. Taxes is one of our biggest expenses, and we need to figure out how to lower that kind of expense. So for our talk today, we're going to begin by understanding taxes with Jeff Akers. Jeff Akers is Vice President of Akers Financial, and he's also a co-host of Winning in Retirement. We'd like to have you pay attention as we go to Jeff Akers.
Hi there. My name is Jeff Akers, Certified Financial Planner here at Akers Financial Group. And because it's tax season, today I'm going to go through a little bit of tax information with you. I'm going to be getting the information from their handy pocket tables tax guide. This is something that you can receive just for watching today, for being here today. And I'm going to go through some of the information in there. It's going to be things like what are the tax brackets, what are standard deductions, what's the capital gains tax rate, and a little bit about an extra Medicare tax. We'll get to that in just a minute. So in order to do that, I'm going to bring up another screen for you to look at so that I can show you what it is that I'm talking about, and you can see what's actually in this tax guide. So here we go. All right, let me scroll down a little bit so you can see at the top here, this one is for 2020. Right now, we're getting our taxes done and it is for 2020. Our tax guide also has 2021 information in it, but for now, I'm just going to go down through the 2020 list over here on the right. So I'm going to go down and talk about tax brackets for joint returns. So married filing jointly. That's what we're going to be looking at first. Over here in this column, you can see the tax brackets: 10%, 12%, 22%, 24%, 32, 35, and 37. You'll see there's a couple of big jumps in there. Most of the time it goes up 2%, one time it goes up 3%, but there's a jump here from 12 to 22, which is a 10% jump. And then a little later on, there's a jump from 24% to 32%. Those are the two biggest jumps in the tax brackets that we need to be aware of and pay attention to. Now, the way this works, after we take our deductions off, then you look at what income is left as taxable income. So over here, when we see these amounts, it's up to that amount. So up to $19,750 is taxed at 10%. Then the amount between $19,750 to $8,250 is taxed at 12%. And then up to $171,000 is 22%. And then $326,000, $414,000, $622,000. We jump up through these tax brackets as we go. So if you're in the 35% tax bracket, so you have taxable income over $414,000, then not every dime that you make, it's not all taxed at 35%. The first part's taxed at 10. You kind of go through all of these, and over here you see the amount up to $414,000. You've paid $94,000 in tax, and then 35% of whatever is over that $414,700. All right, so when you jump up a bracket, it doesn't make everything taxed at that new brackets rate. It's just the next dollar is taxed at that new brackets rate. So how do we get to these tax brackets? Well, I'm going to scroll down through the chart here and talk about standard deductions. Now, in years past, we would itemize deductions a lot because the standard deduction was fairly low. But a few years ago, they raised the standard deductions and made them pretty high. So in 2020, the standard deduction for married couples filing jointly is $24,800. Now, if you're over age 65 and you're married, then you get an additional deduction of $1,300. Now, if you and your spouse are both over age 65, then you get 2 times that standard deduction. So you get $2,600 of standard deduction in addition to the $24,800. For 2020, that comes to $27,400 is the standard deduction for married filing jointly if you're both over age 65. So we take our income, that could be from wages, if we're still working, that could be from pensions, it can be IRA distributions, it can be dividends and interest. Now, there's going to be a special category when we talk about qualified dividends here in a minute. But all these other things just add up to your total income. Then we subtract the standard deduction from that. And what's left is generally our taxable income that those tax brackets we looked at apply to. Okay, so let's go down through the list here. I said before that there's a special rule when we're talking about qualified dividends. Qualified dividends are generally dividends paid from stocks. If you have stocks in a regular individual account or a joint account, those dividends from those stocks are usually going to be qualified dividends. These tax rates also apply to capital gains. Now, a capital gain, if you buy something and then later on you sell it and you sell it for more than you paid for it, that difference is a capital gain. So how are capital gains taxed? Well, if it's a long-term capital gain, long-term means over 12 months. If it's less than 12 months, it's a short-term capital gain, and then it's just like regular income. But if we're over 12 months, then we get these special long-term capital gains rates. So if you're married filing jointly and your income, taxable income, is up to $80,800, then your capital gains rate is 0. So that's a bonus. That's a tax-favored treatment of capital gains right there. Now, for most folks, we're going to have a little bit more than the $80,000, and it goes up to $501,600. In between those numbers of taxable income, your capital gains tax rate is 15%. Now, if you're up close to $500,000, then your tax bracket is 35%. So if your tax bracket's 35%, but you're only having to pay 15% on capital gains, that is favorable tax treatment. Now, if you go over $501,600 in your capital gains, well, your taxable income, then your capital gains are taxed at 20%. Even that is a really good deal, because when you get up that high, you're paying 37% or so on your income. So 20% is a pretty good break. Now, that takes care of our regular income, things that we got from salary, from wages, from IRAs, dividends, interest. We even covered capital gains here, all those kinds of things. There are a couple of special tax, extra taxes that come into play when our income reaches a certain level. And one of those is right below here. It's called the Federal Net Investment Income Tax. This was implemented back when Obamacare, the ACA, was passed and took effect. And it was a way to pay for the ACA, the Affordable Care Act, for healthcare. Now, you see what's highlighted down here? This applies to married couples with more than $250,000 of adjusted gross income. Now, when I say adjusted gross income, they've actually got modified adjusted gross income here. They want to cover their bases. But when I say adjusted gross income, that's your income before you take that standard deduction. So before you take that $27,400 off and you get to your taxable income. So if your adjusted gross income is $250,000 or more, then there's a special 3.8% net investment income tax that's imposed on unearned investment income. So unearned investment income means it could be capital gains, it could be dividends, it could be interest, it could even be money that's come from an annuity that's had a gain or interest in that. So what happens is they'll look at how much unearned investment income did you have, and they'll look at how far above this $250,000 limit you are, and they'll take the lesser of those two numbers, and that will have a 3.8% tax applied to it. So let's say that you had $300,000 of regular taxable normal income, and then you had another $10,000 of net investment income. So total income, $310,000. And then they'll take that $10,000, that's the lesser of the amount above 250,000, or the amount of investment income, and they'll apply that 3.8% to that $10,000. Now, let's say that your regular income might have been $245,000, and then you had $10,000 of net investment income. So now your total income is $255,000. Well, they're not going to apply that 3.8 to the whole $10,000 that was investment income. They're going to apply it to the $5,000 that went over the $250,000 limit. Sound complicated? Well, it happens when Congress gets together and passes new laws. So this is just some of the information that's in our tax pocket table. There are other things in here that talk about IRAs, health savings accounts, one of my personal favorites. It's got the limits in there for health savings accounts. There are also things about retirement plans and contribution limits on things. You may have heard talk about the required minimum distributions, and you want to know, well, how do they figure that out? Well, there's even a table in here that shows you what the divisor is that's used to calculate those required minimum distributions. So that's just a little bit about our income taxes, our tax brackets, our capital gains tax, and that special 3.8% tax on unearned investment income. So that does it for me for today. I know it's taxes, it's not necessarily fun, but it's information that you need to know so that you can apply it to your situation. There's no obligation to maximize the amount you pay in taxes. It's okay to do what we can to reduce our taxes to just the right amount that we actually owe. So that's the kind of thing we help you with. So we'll be happy to send you one of these guides just for watching today. And I will see you again soon.
All right, thanks again, Jeff, for an excellent review of the Kaplan tax guide and the information in the tax brackets. Also in that tax guide is important information about things such as Medicare premium. For many of those that don't know, as you make more income, you could actually pay a lot more on your Medicare taxes, your premium. So Medicare premium is about $148.50 a month. But if you make more than $176,800 in the year 2021, your premium could actually go up by about 50%. And then if you make income that keeps going higher and higher, you can end up paying over $400 a month for Medicare. So you need to understand that Medicare premiums are means-based, based on the income that you show in your return. So if your income is married filing jointly more than $176,000, or if you file single above $88,000, you could be surprised by a higher Medicare premium. So make sure you know where you are so you can watch going over that limit if at all possible. Also this year in 2021, the federal state tax, there's the exemption and a credit. There's an exclusion of $11,580 for 2020. It goes above 11,580,000. For those in 2021, it goes above 11,600,000. That's the current estate tax law, and one of the things that we believe will change in the very near future. So for estates that are larger than 5 million, you really need to consider looking at AB trust and specialized planning when it comes to your income and estate taxes. And what we've done next is this. We put together a talk by Alex Monk. Alex is going to talk about 2020 tax returns, talk a little bit about Roth IRAs, and cover some topics to help you try to save money. So enjoy this section we have by Alex Monk.
Hello, everyone. Thanks for coming today. And for those of you that don't know me, my name is Alex Monk. I'm one of the team of advisors here, one of the advisors on the team here, should I say, at Akers Financial Group. And I want to continue our tax talk today and talk a little bit about some of the mistakes that we've been seeing as people are starting to file this tax year after what was a crazy year, I guess would be the best way to put it. So there are some things going on that you need to look out for this year. So we'll go over those, and then we'll talk about some planning stuff down the road for this year that we're currently in, because there's a lot of fear and wonder about what's the tax code going to look like. So let's start with 2020 year issues. If you're taking the standard deduction, you need to make sure that if you did give money away, when you're preparing your taxes, you put in any cash donations you made to charity, because now they're giving you a credit for up to 300 for married filing jointly if you take standard and you still gave charity. Another thing that just happened here recently is the most recent stimulus bill states that up to 10,200 of 2020 unemployment income, with some other caveats in there, is not going to be taxable. So that, for people that have already filed, is just going to be a wait until they start accepting amendments. For the other folks, they just push the deadline out, and that's kind of the next segue. So the deadline is no longer April 15th. It's now May 17th for the federal government, and state of Maryland has said July 15th. As per usual, no one's talking to each other, so we'll see where it shakes out. But I would expect May 17th to be pretty much in stone, but you never know. Another thing that a lot of people tend to miss is medical and charitable miles. So if you drive to your doctors, or not as much this past year, but track all that stuff, because if you itemize, it is allowed to go on there. Same thing for miles driven to perform charitable service. So if you're dropping off a donation, you can't write off just driving to church every Sunday. That one doesn't really work. But other than that, if you're performing service work, make sure you track that. And then another one, a lot of people refinance if they had a mortgage this past year. Well, rightfully so, rates went way down. But sometimes on those settlement sheets, there's taxes and other things that could be deductible that don't always end up on the 1098 from the mortgage companies. So you want to make sure that whoever prepares your taxes is going through that sheet as well, to make sure that you're not leaving any meat on the bone, as I like to say. But let's talk about going forward. And I guess 2018, the tax brackets changed from the 2017 rates, and that was a good thing kind of overall. So right now we're living in this period where the tax rates are the lowest that they've been in a long time, and most likely the lowest that they're going to be for the foreseeable future. I just don't know how you can print so much money as a government and not raise taxes, and they've already started talking about that. So that could mean that 2021 is our last year at these incredible tax rates. So let's talk about some different things that can help us avoid taxes in the future, because we know for a fact, whether it's this coming year is the last year, or if it's 2025 when these current laws sunset, we know we're going back to the old rates. And the current rates are much, much better. I mean, for this year, the top of the 32% bracket is 414,000. Where coming 2022, maybe, or at least 2026, you have the top bracket of 35, which goes all the way to 470,000. So you're definitely paying at least 2 to 3% more. There's a net investment tax out there right now that we got to be careful of, as well as additional Medicare tax. But the big jumps in there, I mean, the 24, the 22% bracket are a lot better than what's going to be the 25 and potentially the 28 or higher. I would assume they might index some of these brackets for inflation, but you never know with the IRS. And I would assume that the rates are not going to be better than they are now for a long time. So what does that mean? What are some potential opportunities that we have, right? We can convert to Roth, so we can pay the tax now. If that's the case, then we want to look at how can we reduce our other income and have a large taxable conversion. Now, the key to that strategy is you have to have the tax outside of your retirement accounts in order for this to work, to pay the taxes. We can go into specifics one-on-one with you. It's kind of different for everybody, but you pay the tax now. It doesn't count towards your RMD if you have to take RMDs. If you're pre-RMD age, it does help you in the future by reducing your total balance, and you're paying the tax now and never again. So that's a good thing. It just depends on how much time you have to wait, what your tax brackets are, and can we play with your other income? One of the fun things that you can do right now is do a large charitable donation and use as much of that as you possibly can to offset whether it's a large taxable gain that you're going to take or a large Roth conversion. Some of the other ideas are using qualified charitable distributions if you need to satisfy your RMD, and then anything above and beyond that you can convert to Roth. We just need to watch those thresholds because we don't want to jump from the 12% bracket all the way up to the 22% bracket. That's a big jump. We want to make sure we're in that range. But if we're in the 22% bracket, we might want to look at maxing out the 24, because we know that the top of the 24 where it is this year is going to be at least 25, most likely 28% in 2022 or the years to come. So we know for a fact that these rates are going up, so we need to do everything we can to pay the taxes now. There's still programs out there called 1031 exchanges for real estate with large gains that you can use to defer it. I don't know if they're going to take that away, but it's something worth looking at if it applies to your situation. And then right now, capital gains rates are really good. All the way up to, the long-term capital gains rates, the max you're going to pay on that is 20%. It may have some other issues on your other income, but we got to look and see, okay, is this a good year to take gains, or should we do Roth conversions? We really want to meet with people to see how do we but how do we pay taxes on our own terms? And that's what we really want to look at for our clients and prospects as well. How do we maximize our money? And paying less taxes, I think, is a great way to start. And tax efficiency, it can be a really, really big deal. Not just 10% of your money, but it could be 10, 15, and it could have major impacts on your legacy and how you give money. So we definitely want to talk to and sit down with anybody that is interested in not paying more taxes. And most likely, if you sign up for this webinar, that will be you. So we thank you for sitting through. I know taxes can be a dry subject, but we look forward to working for you. And we're glad that you came.
Welcome back. We just finished our second full section. That was with Alex Monk. And this is the very end of our classroom session today. I'm Brian Akers, Akers Financial Group. And we want to invite you to many different things. One of them is this: make sure you listen to the radio show. If you cannot listen to the radio at 11 a.m. on Saturdays, why don't you consider going to our website, akersfinancial.com, and look at the radio tab, click that button. And what you'll find is that you're able to listen to past shows with different topics. We also have a webinar tab. That webinar tab, what's great about that is it shows the past webinars. You can actually see a webinar that we did on taxes in retirement, a specialized talk that I did back in December, just a couple months ago, that you can review and go over. Now, in today's talk, we wanted to cover income taxes as they are right now. They will change this year and even next year. We think there won't be any major changes to those that make less than $400,000 this year in calendar 2021, but we do think there will be changes, and we got to be ready and informed by that. We do that through our weekly email, our weekly radio show, and webinars like this every 2 weeks. So Akers Financial Group, our goal is to inform and educate at all times. Make sure you pick up that free blanket. That free blanket is available to all those that actually have the first time you sign up to get that. Also today we have the Kaplan newsletter program pocket table, which is pretty nice program. Looks like a program. It's more of an accordion. This keeps going, Really nice. Lots of small writing, but a lot of guides in here. You can tell you 401k limits such as $19,500 again for 2021. Also, if you're over 50, you can put more money in, up to $26,000 for 401k, 403b. The IRA limits of $6,000 below 50, $7,000 above. And then there's income limits to be able to do Roth IRAs. We love Roth IRAs. We love a lot of things. Now, when I was listening to the talks, one of the things I found was there's some notes that Alex Monk said. He said this: pay tax on your own terms. Paying tax on your own terms, very important topic. That's what we try to do in financial planning here at Akers Financial Group. If you're not a client already, feel free to give us a call and set up a free initial meeting to go over where you are. We call that your financial fingerprint. We need to know and understand where you are, talk about taxes and investments, insurance, everything you do when it comes to your financial planning. We bring it all together, trying to give you the best advice possible. And then we must review on an annual basis. For all those existing clients listening, we do need a copy of your return every year so we can keep up with what's going on your actual individual taxes. We think this fall, the fall of 2021, is a very important time of this year to do Roth conversions. The reason in the fall is that we need to wait and see what the laws are for the year 2021. Things are changing rather quickly at this moment. A lot of topics are covered, but not everything that might have applied to your exact situation. But maybe you need to get to know an advisor here at Akers Financial to get more information. Alrighty, I was thinking about what else I need to cover. Remember, tax due dates are May 17th, and also for Maryland, it is July 15th. The Kaplan Guide, you get that just for signing up today. The blanket for first-time people, and we love and enjoy working with you. And thank you very much for staying awake, paying attention. Enjoy your time. Thank you very much. Bye-bye.